It's been an incredible year on the stock market, and there have been a number of stocks that have led the way, gaining over 100% in value this year. So I'm going to go through 10 of those stocks and what investors can learn not only about 2024, but what to look for in 2025. The winners from last year may not be the winners of next year, but historically, stocks that lead the market in a given year are likely to do well in subsequent years. So I want to go through some of the drivers. So hopefully this will be a valuable list for you to look at. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you want more, check out my newsletter, Asymmetric Investing. There's a link on the screen. There's also a link in the show notes. That's where I'm sharing all of my research, stocks that could 10x in value over the next decade. I'm building a real money portfolio, buying stocks every single month. And oh, by the way, that portfolio is beating the market by a wide margin in 2024. I'm going to go through the results of that here on YouTube and of course on the newsletter at the end of the year, and my new buys for 2025 will be up before the market opens next year. Now I'm going to go through this list of 10 stocks in market cap order. So I'm of course going to start with NVIDIA, just another phenomenal year for NVIDIA. And I will be back with that in just 1 second. Heads up folks, interest rates are falling, but you can still lock in a 6% or higher yield with a bond account from public.com. Now this is a pretty big deal because when interest rates drop, so can the interest you earn on your investments. But a bond account allows you to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds. You can see what that looks like on the screen. So while other people are watching their returns shrink, you can sit back with regular interest payments, but you might want to act fast because the yield is not locked in until you invest. The good news is it only takes a couple of minutes to get started at public.com. Lock in that 6% or higher yield with a bond account only at public.com/ASYM. Shares of NVIDIA are up an incredible 183% in 2024. So what has driven those results? Well, let's first take a step back and look at the trends from revenue, operating income, and net income over the past decade. You can see that a decade ago, this was a company generating $4.7 billion in revenue, barely profitable. That has changed dramatically since ChatGPT was introduced late in 2022. But what's driving those results and the massive growth that NVIDIA has seen? Of course, it is the data center. This is where you're going to see the impact of artificial intelligence and NVIDIA's lead in the data center there. That's how you see revenue from the data center going from $1.9 billion in 2018, fiscal 2018, to $98 billion over the past year. That is almost entirely from artificial intelligence and data center workloads. Companies like Microsoft, Alphabet, Meta, CoreWeave, all buying billions of dollars worth of NVIDIA GPUs. So that has really been the story of 2023 and 2024 for NVIDIA, is just this phenomenal rate of growth. But going into 2025, we need to start thinking about things a little bit differently. The ChatGPT moment was now 2 years ago. So the companies that are buying all these chips have a bigger and bigger incentive every year not to be dependent on NVIDIA. We have seen this with the growth of demand of TPUs from Alphabet, with Amazon introducing their own inference chips. You also see less gains from pre-training. That's basically training the artificial intelligence model can cost billions of dollars. And that's typically all done on NVIDIA chips. So now as we move to more of that workload moving to inference, it's likely that other competitors are going to come in and start to take market share. So what are we going to need to watch in 2025 to see if this is going to be another great year for NVIDIA? Let's start with their margins. NVIDIA's margins have been incredibly high, higher than their typical margin of 50 to 60% over the past couple of years because there's very high demand in the GPU market for those pre-training models, and the software infrastructure that NVIDIA has built has become more and more powerful. So they can basically name their price when they're selling H100s and now Blackwell chips. That's how you see margins go from 65% to 78%, and operating margins now exceeding 60%. But what have we seen over the past couple of quarters? NVIDIA is starting to give back some of the margin that they've gained over the past few years because the market is going to be more price competitive. I mentioned the big buyers of NVIDIA chips are starting to develop their own chips. They're starting to look for alternatives. They're starting to help companies like AMD because they don't want to be single source. They don't want to be reliant on NVIDIA. So we're going to need to watch that data center growth rate that I showed earlier that the rate of growth is starting to slow. So we're not seeing 200% growth. We're seeing a little bit less than 100% growth in the data center. How far does that slow in 2025? Does it go to a 60% growth rate or does it go to a 30% growth rate? That's something that investors are going to be really keyed in on. And I'll get to the valuation, the reason that those numbers are so important in just a second. But also look at those margins. Does NVIDIA have to give back some of those margins because they, one, don't have the same pricing power, and two, some of their suppliers are taking more margin as well. Memory suppliers are going to be key to that, and so is a chip supplier like TSMC, who is raising their prices on leading edge chips that are going to NVIDIA. Here's the other thing, and this is what really worries me as a stock investor, is that NVIDIA has been a phenomenal beneficiary of what's called multiple expansion. 10 years ago, you could have bought NVIDIA stock for 18 times earnings. Now shares are trading for 54 times earnings. Yes, those earnings are growing, but the multiple that you're paying is much higher. That means that the downside risk is higher if growth slows, if margins start to compress. Instead of being a tailwind, I think multiples are going to be a headwind in 2025. Price to sales multiple is even more stark. You can see here that the compound annual growth rate of just the multiple has grown at nearly 30% over the past 10 years. So 10 years ago, you could have bought NVIDIA stock for 2.4 times sales. Now the stock is trading for 30 times sales. Just ask yourself, what happens to NVIDIA if the AI boom starts to slow down? Companies say, you know what, we're not seeing the returns that we need to invest hundreds of billions of dollars in more AI chips. We have our own supply, and NVIDIA's growth rate goes to zero. It's not unusual for NVIDIA to actually have negative growth years, so that could absolutely happen. But what happens if growth goes to zero? Does that price to sales multiple go from 30 to 5 or 10? That would be a tremendous impact on the stock. So this has been the biggest winner of the past 2 years on the market, but will that continue in 2025? Hopefully those items to look at: revenue growth in the data center, both gross margin and operating margins, and also multiples. What are investors expecting for future growth rates? And is the company living up to the current multiples that the stock is trading for? Those are going to be the 3 things to watch in 2024. To see if this is a company that can continue to beat the market. The second stock is Broadcom, a relatively quiet player in artificial intelligence until 2024. That's when the company saw its stock go up 122%, and a lot of that was based on both data and speculation that the company's AI business is going to grow significantly in the future on the back of their partnerships with Google, who is making TPUs or tensor processor units. They use Broadcom technology, and that's going to be a multi-billion-dollar business for Broadcom. On top of that, we have Apple, which is developing its own chips for Macs, for iPhones, for iPads, and they are using Broadcom's technology as well. Let's get to some of the reporting and then also the growth rate, which is just phenomenal at Broadcom right now. So this report came out in mid-December, and Omdia's research is saying that Broadcom is shooting for $12 billion in AI semiconductor revenue this year, and that is driven by TPU, which is going to account for about half of that. On top of that, Apple is reportedly working with Broadcom to develop AI chips. That makes a lot of sense because Apple is trying to move that inference on device for their artificial intelligence models. Basically the opposite model from what you see with NVIDIA. NVIDIA wants to do everything in the cloud. Apple wants to do everything on device, or at least everything they can. So what does that performance look like for Broadcom's business? You can see from this chart that semiconductor and infrastructure solutions now generate $51.6 billion worth of revenue. That's up from $35.8 billion just a year ago. So remember I talked earlier about how NVIDIA is going to start to see more competitors coming into the market because those huge buyers of NVIDIA chips don't want to be beholden to NVIDIA. So they're going to work with companies like Broadcom. So that's why you see Google working with them, Apple working with them. They're probably the two that are leading in building a non-NVIDIA infrastructure in artificial intelligence. And as they grow, we're going to see Broadcom grow as well. Now, from a valuation perspective, we're going to see the same challenges that we see at NVIDIA. You can see that in the sidebar here. The company's PE multiple is over 100 right now. If you look at a forward basis, the PE multiple gets a little bit more reasonable at about 38. Enterprise value to sales is over 20 on a trailing basis, slightly under 20 on a forward-looking basis. So what investors are expecting is that NVIDIA growth that we have seen over the past 2 years is going to be growth that's going to be trending towards Broadcom over the next couple of years. But to me, the same questions remain. Are we going to see multiple expansion like we've seen over the past decade? You can see that price to sales multiple has grown not quite as quickly as NVIDIA, but a 17.7% compound annual growth rate over the past decade is just a crazy growth rate. That price to earnings multiple is going to be volatile over time, but that's why I like to look at the price to sales multiple on some of these really highly valued companies. I think we're going to see the similar challenges to what you see with NVIDIA. So who has growth accelerating in 2025? Who has growth decelerating? So that means that a company can still grow, but the growth rate is coming down. That's what investors don't want to see when companies are this highly valued. But both NVIDIA and Broadcom riding similar trends going into 2025. That's why they're a couple of the best performing stocks in 2024. Now, if you thought NVIDIA and Broadcom were expensive, let me introduce you to one of the best performing stocks of the year, Palantir. Shares of Palantir are up 378%. This has become something of a meme stock, and that's because on social media, a lot of investors have bought into what Palantir is selling about the future in both of their artificial intelligence, both for military purposes, but also for corporate purposes as well. You can see here from the company's revenue and net income chart that this is a very solid company, consistent revenue growth, solidly profitable now. And we can see that week after week, the company is announcing new partnerships, new deals with both corporations and also the military. So these are long-term contracts the company is going to benefit from, very high margins coming in. And this is becoming a platform that a lot of organizations are relying on. Now, the question, again, like the first two stocks that I talked about, is what in the world should you pay for a company like this? And let's just look at those multiples. For Palantir, this is not a business that's growing at the same rate as a company like NVIDIA, which has really driven NVIDIA stock this year. You can see that really multiple expansion has been the story for Palantir this year. Coming into the year, shares were trading for about 17, 18 times sales. Now the stock is going for 70 times sales. This is when alarms should be going off in your head as an investor. Any company that is trading for 50, 60, 70 times sales. We saw this during 2021 when there was this tech boom. We saw companies like Cloudflare trading for over 100 times sales. Guess what? That didn't work out well for investors. Cloudflare, still a phenomenal business, much better business today than it was in 2021. Very possible that Palantir will be a much better business 3 years from now, but the stock will not perform well. And again, are we going to go from a period of multiple expansion to a period of multiple compression? I just want to put a couple stats to this based on what analysts are expecting over the next couple of years. For the next 2 years, analysts are expecting 25% growth annually for Palantir. That's a really, really good growth rate. But if that happens, in 2 years, the company will still be trading for about 45 times sales. So that's why paying these kind of multiples is really a dangerous territory for investors. A lot of hype behind these stocks right now, a lot of growth expectations already built in. If the company in any way underperforms expectations over the next few years, even if it's not analyst expectations, it's just what now is being priced in when you have a stock that's trading for 70 times sales, that could push a stock significantly lower. The drawdown in Cloudflare stock between November 2021 and June 2022 was 81%. Over that time, the company continued to grow its revenue. It was just simply the stock and the multiples that came down over that period of time. So that's what I'm going to be watching in 2025. Palantir is not a stock that I own, not a stock that I'm particularly interested in owning at this price. But if it does come down 70, 80, 90%, which is very possible, now it becomes much more intriguing for an asymmetric investor like myself who is looking for upside that I don't have to pay for. That's the key with NVIDIA, Broadcom, and Palantir right now. Investors are paying for upside that doesn't yet exist. They're paying for growth. I want to get that upside for free. I want to get that growth for free. So that's what makes me a little bit hesitant about these first 3 AI stocks. For the rest of this list, we're going to take a bit of a break from artificial intelligence and go to businesses that are performing extremely well, but again, are benefiting from multiple expansion because their stocks are up over 100% this year. The fourth stock has outperformed all of the AI stocks I've talked about so far. That is AppLovin. Shares are up 759% in 2024. So what in the world happened with this company? Why did it go from being on the outs with investors to being one of the most popular stocks today? Let's start with a long-term chart. So this goes back to 2018. You can see that solid growth company. That growth kind of levels off in 2022, and AppLovin actually loses money that year. But that has turned around dramatically over the past couple of years. So what in the world happened? First of all, this was a company that was built on advertisements for apps, in particular for games. So when you play a game and you see an advertisement, that may be an AppLovin advertisement. You click on an ad, and the company is going to generate revenue if you install that ad. When Apple's app tracking transparency came into effect, that tie between a click and monetizing that click broke. Basically, advertisers couldn't track that advertisement, particularly in the gaming sector. That's happening on iOS devices, and the immediate impact would be installing an iOS app. That's where most of the money was made. So the business clearly suffered in that period of time. But what's happened since then? AppLovin has gone from being primarily a gaming company and an in-app purchase company to being a software company. This is now a company that can connect advertisements with other sorts of demand. You can see that change in the business in this chart right here. This is an annual chart. The dark column is app revenue. You can see that that's actually down since peaking in 2021. So no real surprise there given the app tracking transparency changes. But look at the software platform revenue. That has grown at a compound annual growth rate of 75%. And you can see that that revenue is actually accelerating recently. Not only is that good news that that revenue is accelerating, this is also very highly profitable revenue. And the addressable market outside of the gaming industry is much bigger than it is inside gaming. Its Axon engine is now being used for e-commerce. So there are more use cases than just gaming for AppLovin's technology, and that increases the addressable market, increases the growth rate, and that's why investors are willing to give it the kind of multiples that they have. As I'm recording, the price to earnings multiple is over 100. The forward multiple is about 62. And enterprise value to sales is 28 on a trailing basis and 22 on a forward basis. So given the growth rate of that software platform, about 66% in the most recent quarter, this is another phenomenal growth company. But the biggest reason that it was a phenomenal performer for investors in 2024 was because that growth materialized and then the multiple expanded. So that's really the theme here. A lot of these stocks have gotten very expensive because the narrative around their business changed from the beginning of 2024 to the end of 2024. The expected growth rate in the future went up significantly, so investors were willing to pay a higher multiple. Now, I think AppLovin has a phenomenal opportunity to grow ahead as there is more e-commerce, as there's more opportunities to build these advertising platforms that are outside of the traditional ecosystems. But is this rate of growth going to continue? We'll have to see, because if it doesn't, that's going to be the risk for investors. And of course, if it does, if this is a 100% growth rate company with the growth in e-commerce and everything outside of gaming, this could continue to be a solid performer. So we'll see what happens with AppLovin in 2025. Definitely a company to keep your eye on. Stock number 5 is Spotify. This is up 142%. This is also the biggest holding in the asymmetric portfolio. I'll put a link to both the deep dive and also the asymmetric portfolio in the show notes so you can look into those if you would like, but started acquiring position in this stock in late spring of 2023. It's just been on a phenomenal run, and there's a great reason why. In 2023, Spotify started to cut their operating expenses to get them more in line with the revenue growth that they were seeing. So that revenue has continued to grow, steadily adding subscribers both on a free basis and then also a premium side of the business. And they've increased prices. So that has accelerated their revenue growth and expanded those margins. Now, Spotify is never going to have 90% margins like we're seeing with some of the companies that I've covered already. They're going to have margins closer to 30% because they need to share about 70% of the revenue with artists and creators. But that margin is starting to tick higher, and that's because the company has really won the music business and now is expanding into other businesses like audiobooks and like video. So we're going to see the margin opportunity probably increase for Spotify, especially as advertising becomes a bigger piece of the business. Advertising typically, even when you're sharing revenue with creators, like a platform like YouTube does, your margin is going to be closer to 50%, your gross margin. You're not going to have to share quite as much with those creators as you do when you're making deals with big record labels like Spotify typically has done in the past. So we're going to probably see margin expansion continue in the future. And again, this is why investors are saying that Spotify deserves a little bit better multiple than it had in both 2023 and then coming into 2024. That's why the stock has done so well, because not only is it doing better operationally, it's getting a better multiple from investors. Now, is that going to continue? Spotify stock is relatively expensive today. Price to earnings multiple is 129 on a forward basis. That's 54. Now, I think there's a lot of opportunity for increased net income for Spotify, increasing cash flow. All those things have been moving in the right direction, but it's hard to state that this is going to be a cheap stock to be buying today. A lot of the upside just from multiple expansion has already been priced into the stock. But this is also not as expensive of a company as some of the others that I've talked about with the enterprise value to sales of 4.9. So if they are able to increase those margins beyond 30%, that could give significant upside to Spotify. But I think at the end of the day, Spotify has really won the audio market. I've talked about this on Asymmetric Investing as the smiling curve. If you're the company that wins the market in a specific business like this, you become the go-to place. That means that you have both the most subscribers and the highest prices per subscriber. We don't talk about this a lot, but Spotify actually charges more for a subscription, a standard subscription, than you can get from Amazon, YouTube, or even Apple. That's because they're now bundling in audiobooks, but that's also helped them push their margins a little bit higher. So they're starting to flex a little bit of that pricing power now that they've won the audio market. Now the question for the future is going to be, can they expand into some of these other markets? Audiobooks is a natural market to expand into. Maybe not the biggest market for Spotify, but if they can get into something like video, which you're seeing more and more, you're seeing more and more tools, more and more advertising tools that both creators and advertisers are going to be able to put into their videos. Is this a company that's going to start competing with YouTube, at least for video podcasts, for education tools, where there's going to be some sort of subscription or one-time payment? Those are niches that Spotify could potentially grow into and bring hundreds of millions of users to the creators that are building on their platform. So this is why Spotify is doing well and why investors are betting on the future of the company. I think this company has a bright future. Very possible that the stock doesn't do well in 2025 if those multiples start to come down. But I'm watching those margins. If those margins continue to increase, I think this is going to be a company to own for the next 10 or 20 years. And that's what I want to do with asymmetric investing. One of the strangest years goes to Microstrategy. Shares are up 382%, and that's largely because of the rise in Bitcoin. But the odd thing about MicroStrategy is that this is now a company that is just holding Bitcoin on the balance sheet and trying to benefit from an arbitrage between its stock price value, the market cap of MicroStrategy itself, and the value of Bitcoin that it holds. If the value of MicroStrategy exceeds the Bitcoin that's on the balance sheet, what management will do is issue shares to buy more Bitcoin. They're calling this Bitcoin yield, which is something that Michael Saylor made up to try to convince investors that there is value in this strategy of issuing shares to just buy more Bitcoin. Now, the strange thing about what MicroStrategy is doing is that this works until it doesn't. If the value of MicroStrategy falls to a point where there's a discount to the Bitcoin in the balance sheet, which is typically the way that exchange traded notes trade, the way that ETFs that are based on commodities like gold typically trade for at least a small discount. But MicroStrategy has traded in the opposite direction in 2024. That's why they've actually been continually issuing shares and issuing debt to buy more Bitcoin. That's created a virtuous cycle in Bitcoin itself, increasing the value of Bitcoin, which passed $100,000 per Bitcoin this year. But does that reverse in 2025? I think that very well could be the case. Not only could Bitcoin fall, but the premium that MicroStrategy shares trade for could come down as well. That spread between the Bitcoin value on the balance sheet and the value of MicroStrategy stock could come down, creating kind of a dual negative for MicroStrategy. Not only will the stock price come down, but also the company will be able to buy less Bitcoin in the process. And if you're valuing the company based on Bitcoin, well, Bitcoin needs more buyers to increase the price of Bitcoin. This is the biggest buyer in the market. If they don't have a highly valued stock that they can issue to then buy more Bitcoin, the house of cards could fall apart. So Michael Saylor has executed this Bitcoin strategy brilliantly so far, but it is very possible that MicroStrategy's ability to buy Bitcoin and push Bitcoin further is not going to take the company much further than it is today. I think this could be a disappointing year for investors, not only because that premium could come down, but also Bitcoin could come down from recent highs that came after the election. Remember that since the pandemic, Bitcoin trades in a more correlated manner to a growth stock than it does to an inflation hedge, which it is proven not to be. So something to think about for investors. With MicroStrategy, you're not getting much of a business at all. There's about $467 million in revenue from the business. Operating income from MicroStrategy is actually negative. So the operating business isn't much to speak of at all. This is now a Bitcoin treasury company. And as Bitcoin goes, so does MicroStrategy. The seventh stock is Axon. Axon shares are up 143% this year, and the company continues to perform extremely well. The question is going to be, how high can the stock go given the current valuation? I'll get to those valuation numbers in just a second. But let's start with some operating numbers, because this is one of these companies I've held for nearly a decade at this point, and just been a phenomenal growth story, compounding at about 30% per year like clockwork. They have also made the transition to net income positive. Now, $300 million in net income is not a ton when you compare that to the company's nearly $48 billion market cap. But it's hard to argue, like a lot of the stocks I've talked about here, that this is not a phenomenal business. The question is just, what do we pay for it? You can see that just in the past year, Axon's price to sales multiple has gone out of whack with where it's traded over the past decade or so. Going back to 2015, 2016, you could get Axon for 5 to 8 times sales. And this is when the company was growing at 30% per year. But right now, shares are trading for nearly 25 times sales. And that price to earnings multiple, remember, it's a profitable company now, but the stock trades for nearly 160 times earnings. So again, the question is, so this is not a question of, is this a good company? It's a phenomenal company. They have long-term contracts to sell not only hardware, but services as well to law enforcement agencies around the world. They recently got a bump when Walmart said that they were going to start using body cameras. We don't know if those are actually Axon body cameras, but that could potentially be another growth market, is the enterprise market. They've also talked about the consumer market being another big potential market for them, not only for body cameras, but for tasers as well. So the market is pricing in a ton of growth for Axon. The company has delivered for a very long time. But the theme here is that a big part of the gains that Axon had in 2024 was from multiple expansion. So part of it was revenue expansion. Part of it was going to be really good margins in the business. But a big chunk of those gains that we've seen is just from a higher stock price based on higher expectations for investors about the future. Is that going to come to fruition? We may be at a point where there's peak optimism about growth in the future. We saw this in 2021. That led to a pretty bad year in 2022. And that was actually when there was an opportunity to buy some of these really phenomenal businesses and hold them long term. So just something to think about. Multiple things can be true with a lot of these companies. Can be a phenomenal business and can be an absolutely crazy price to pay for them right now. I think Axon falls in that category. I have trimmed my position a little bit in 2024, but as you can see with the gains recently, gave up a little bit of upside as I did that. Number 8 on this list is shares of Robinhood. They're up 216%. This is one that is also in the asymmetric portfolio. So again, I'll put a link to that portfolio in the show notes, along with the deep dive I did when I started a position in Robinhood. And everything is played out really as planned with Robinhood. Assets are coming onto the platform at an incredibly rapid rate. And I think the differentiator, which doesn't get talked about a lot, is Robinhood Gold. Robinhood Gold is their membership subscription, costs about $5 a month, about $50 a year, and you get a number of benefits for being a member. You can get the Robinhood Gold credit card, 3% cash back with that, so that's going to be better than you're going to get with any other free credit card. You get bonuses for depositing into a Roth IRA. There's periodic bonuses for just depositing into your brokerage account. You get better APR on the cash that's sitting in your account. A lot of benefits for being a member. And this is really reminiscent of what's happening at Costco. Costco can operate their business in a very different way from all other retailers because they make most of their profit on their membership. So you pay to be a member of Costco, and then the Costco store itself is basically run on a break-even basis. That was my thesis with Robinhood when I started that position, and it's really started to play out, attracting billions of dollars to the platform. That allows Robinhood to make money on everything from payment for order flow to margin accounts to credit card fees and balances, everything that financial institutions can make money on, whether we're looking at financial services or investing services, which is where they started as a company. So I think really disruptive company, and that has played out in 2024. Now, like we've talked about with a lot of stocks here, getting pretty expensive, about 67 times earnings. On a forward basis, that price to earnings multiple is almost 40, and the price to sales multiple is almost 15. So that's a pretty expensive price to pay for a company that's in a very competitive environment in the brokerage services and financial services business. But I think Robinhood has significantly more upside than a lot of its traditional competitors because it's a digital first platform and the markets that they're growing into have a lot of potential. This has primarily been a US based company, so they have a lot of opportunities to grow internationally. They're increasing the number of accounts that they have, so they don't have things like joint accounts or custodial accounts. Moving more into retirement, that is up 8 or 9x in 2024. So that was a phenomenal growth story. I think there's multiple of these growth stories that they can grow into over the next decade. And remember, Robinhood is riding a long-term wave of millennials, which are the primary users of the Robinhood platform. Millennials are going to be inheriting hundreds of billions of dollars over the next 10 to 20 years. So that's going to be a huge tailwind for the business. And if they can capture that wallet share, as they call it, that's going to be tailwinds that they're going to ride to double-digit growth for the foreseeable future. So I still love Robinhood. That price is That price is getting pretty expensive for the stock, but that's the theme for all of these companies that have done really well this year, is that multiple expansion was a big piece of the story. The number 9 stock here is Carvana. Shares of Carvana are up 340% in 2024. This is after a phenomenal 2023 as well. The company was basically left for dead at the end of 2022, so they've really come out of that. What's interesting with Carvana's move is there's 2 pieces of it. There's the fact that the company isn't going to go bankrupt. That was what a lot of people, including myself, thought at the end of 2022. That didn't happen. They got the funding that they needed. So you take that risk out of it. That's going to help the stock valuation. And then the company has gotten to profitability over the past 12 months, but not a huge growth story recently. They've had a bit of a comeback in 2024. Revenue is now growing again, but not near where they were at September of 2022. They benefited from the margins of all of the ancillary services that they're selling along with vehicles. So they at least seem to have gotten their business to a much more sustainable place, but now the valuation is really what investors need to question right now on a forward basis. Price earnings multiple is about 93, and the enterprise value to sales, remember, they're not going to have a huge margin because they're selling vehicles, but that's over 2 right now. So is Carvana going to be able to grow into that multiple? Well, they're going to have to keep expanding margins. There's going to be limits on how much they're going to be able to do that because, again, this is a very competitive auto business. But if they are able to capture more market share and especially keep generating revenue in some of those non-auto segments, so reselling services for other companies, selling warranties, those are very high margin items that they could be able to keep those margins up where they are today. So phenomenal recovery by Carvana. Definitely not one that I'm buying going into 2025 because I think that growth story and the margin expansion story could come to an end, especially as the used car market becomes much more competitive and those prices potentially come under pressure as new vehicle values come down in 2024 and 2025. So phenomenal comeback story. I don't know where it's going to end. This one is just in the too hard pile for me as an investor. And the final stock for today is Toast, which is up 108% in 2024. The interesting thing about Toast is the growth story hasn't really changed for the company, and it's still losing money. You can see that from this chart. Lost $49 million over the past year. Now, a lot of that is coming from stock-based compensation. So on a free cash flow basis, the company has generated $253 million worth of free cash flow. So the price to free cash flow is about 86 right now. We don't have a price to earnings multiple because the company isn't profitable, but that's a decent way to look at the company's valuation. Now, Toast is in an interesting position because I think they've really come to dominate their restaurant niche. This is a platform that I actually started using as a restaurant owner in 2017. And now their method of operating, where you have these little handheld devices that will accept credit cards, have kind of become the standard in the industry. They've, of course, built out this niche, built out a great operating system with everything from reservations to the back end for the kitchen, for bars. Everything that you need to run a restaurant can happen on Toast. They also have things like capital that you can take out. You can pay your payroll on Toast. The ecosystem is becoming bigger and bigger and stickier in the process. Again, the question just becomes, how far is this company going to run? The enterprise value to sales multiple is about 3.5 right now. And this is still a relatively low margin business because a lot of their revenue is coming from transactions. They're not going to take much margin from those transactions. So most of their profitability is going to come from subscriptions. Those subscription services are going to depend on growing the number of restaurants that you're going to have in the ecosystem. They've obviously been able to do that over the last few years. But again, this is a very, very competitive environment. So do competitors start to come in and undercut them on price? That would be the one thing that worries me. And one of the things that's kept me out of Toast. There's a lot of competition in this space. There's multiple companies that are doing similar things. Everybody from Square to PayPal are really trying to get into Toast's business. And a lot of those companies are much bigger than Toast is today. So phenomenal niche for Toast. This is a business that I would love to own, but I want to own it at a no-brainer price. And I just simply don't know where that is today, given the fact that the company is not profitable and it's not trading at a compelling price to free cash flow multiple. If that price to free cash flow multiple, even if the company was unprofitable, was closer to 10 or 15, that may be more compelling. But analysts are only expecting about 25% growth over the next couple of years. So I think this is a pretty expensive price to pay for Toast. But again, the theme of the day, phenomenal company, just a price that I'm not quite willing to pay for Toast today. So there you have it, 10 stocks that are up 100% or more in 2024. Just a phenomenal year for all of them. NVIDIA, Broadcom, Palantir, AppLovin, Spotify, Microstrategy, Axon, Robinhood, Carvana, and Toast. Which one of those are your favorites? Which ones do you actually own? I mentioned that I own Robinhood and Spotify in the asymmetric portfolio. So check out Asymmetric Investing at asymmetric-investing.com. I've got all my deep dives there. I'll put some links in the show notes and in the comment section as well. But give me your thoughts on these stocks and who do you think is going to perform well in 2025. I will be back here on Asymmetric Investing at the start of the new year with my top picks for 2025. So don't miss that one. Thanks for watching, everybody. See you here next time.